I'm going to talk about a trading cycle around the Fed's balance sheet. And the Fed was supposed to start quantitative tightening in June. Originally it was May, and then now in June. They had the FOMC statement this past week raising rates 0.75%, and they increased the balance sheet. So far this month, the balance sheet has gone up. And you see here's June 1, 8.915 billion. June 8th, 8.918. This is in thousands, so the number looks like 8.9 billion. It's really 8.9 trillion. So 8.915 trillion to 8.918 trillion is a $3 billion increase, and then up to 8.932 trillion is a $14 billion increase. $14 billion increase on the week that they raise interest rate 75%, 0.75%. Not 75%, but 0.75% increase in the Fed funds rate. Balance sheet went up, and we talk about how the market is propped up, and you wonder who the player is behind that. And will the market soften on weeks that the balance sheet is reduced? And so looking at two time periods, the peak in the balance sheet is right here, 8.965 billion. So the two time periods that the Fed's balance sheet is actually decreased are April the 13th through the April the 27th. And then again on May 18th through the May 25th. And if you look at the charts, the market went down during that time period. The only problem is its information is delayed. And so this is Wednesday through Wednesday data. June 15th was Wednesday, the day of the FOMC. And since that time period, they may have started decreasing their balance sheet from say June 15th through June 22nd. We might see a drop because this is the month, and that is the kind of the time frame we're seeing. This time period was 2 weeks, but it included the third Wednesday through the fourth Wednesday and third Wednesday through the fourth Wednesday here. And so we could see in the next week or two a reduction in balance sheet, and that could potentially cause less prop-up price action. It's an interesting study. Since it's delayed data, we have to anticipate when they're going to decrease their balance sheet and how that could affect the market. We know that the balance sheet has increased, and that has caused the market, has been part of the market's rally into extreme bubble territory and also causing inflation. And so since they didn't say much about reducing their balance sheet at the last Fed meeting and it's gone up, you have to wonder if they have maybe changed their policy or second guessing that policy. While they have increased interest rates, they haven't second guessed that policy. Have they second guessed the balance sheet reduction, which I think will have an even greater effect on the stock market? And so you have to take that into consideration. Your trading could be the best time to take on short positions or hedging on the short side. Just to take a look at the Fed's balance sheet, this is what happened since the pandemic, and you can see that the market has gone up. Accordingly, it's very correlated to the market. If you go back to the Fed's balance sheet, here's the 2009 financial crisis, and the market has been very correlated with the Fed's balance sheet. As long as the Fed has supported the market, you hear the phrase, don't fight the Fed. Before the financial crisis, the Fed's balance sheet was less than $1 trillion. You see right there, $909 billion on August 27, 2008. And since that time, it's multiplied by 10. And we know the stock market has also gone up. Real estate has also gone up. And so this is part of the issue with inflation. And so it needs to be reduced. And we'll see if that happens and what is the best way to trade it. As we discussed, potentially the third Wednesday of the month could be a weaker time period in equity prices. And so we'll see if they follow through on that and see what the effects are on the markets. Hey, David Bean here. Welcome to Capstone Trading Systems YouTube page. Be sure to subscribe to join our community of algorithmic traders. We are real money traders. We share our winning streaks, we share our losing streaks, as well as market updates, strategies, and coding tips.